Attempting to measure a Philippine cooperative using standard corporate profit-centric indicators will inevitably result in a complete regulatory failure. Under Republic Acts 9520 and 11364, the Philippine state views cooperatives as unique collective organizations, entities mandated to drive social equity and rural economic development, requiring a specialized compliance regime. This structural model shows what it takes to secure the Mandatory Certificate of Compliance, or COC. A cooperative must successfully navigate a tripartite audit architecture, integrating traditional financial auditing, structural performance evaluations, and qualitative social assessments. Failing to submit this mandatory reportorial package on time triggers daily monetary fines, the revocation of tax exemptions, and the cancellation of cooperative registration. Every cooperative must secure the COC as the definitive legal proof of its social equity and financial soundness. This strict oversight is the product of more than a century of legislative shifts, dating back to the first legally recognized Philippine cooperative in 1908. During the post-war era, under Commonwealth Act No. 713, early enactments treated these groups as government-directed relief channels for economic reconstruction rather than autonomous enterprises. State involvement intensified during the martial law period. Presidential Decree 1775 built a top-down structure, establishing primary cooperatives and provincial banks to support agrarian reform at the direct expense of cooperative autonomy. The modern regulatory philosophy, codified by Republic Act 9520, reverses this. It embraces the principle of subsidiarity, granting the sector the authority to initiate and regulate its own ranks. Transitioning from state-directed conduits to autonomous institutions mandated the creation of the sophisticated, self-reliant compliance systems cooperatives use today. This comparative ledger visualizes our first pillar, the financial audit. While corporate entities use standard accounting rules on the left, cooperatives operate under the specialized Philippine Financial Reporting Framework for Cooperatives, or PFRFC, on the right. This framework enforces structural conservatism. A major divergence is the strict prohibition on recognizing unrealized gains or losses in the statement of financial condition. Additionally, a cooperative cannot classify its net surplus under general retained earnings. By law, it must be distributed into 4 distinct statutory allocations: the Reserve Fund, the Cooperative Education and Training Fund, the Optional Fund, and the Community Development Fund. Verifying these strict accounting treatments requires a highly credentialed professional. Under Memorandum Circular 2026-03, a certified public accountant must earn specialized accreditation from the CDA to serve as a cooperative external auditor. This accreditation operates on a 5-year validity cycle and enforces uncompromising conflict of interest rules, barring any auditor related to cooperative management up to the 4th degree of consanguinity. The regulator also mandates corporate social responsibility. To renew their accreditation, external auditors must provide pro bono auditing or accounting services to at least 3 micro-cooperatives. The PFRFC and these rigorous auditor rules exist to ensure that capital is structurally locked into local cooperative development, rather than speculative corporate growth. This updated scorecard illustrates the second pillar, the performance audit. Under Memorandum Circular 2021-04, the CDA overhauled the legacy PISO standard, replacing it with this modernized 2-part evaluation. The first component is the Governance and Management Report, carrying a 40% qualitative weight. It physically verifies the presence of structured human resource files, approved board minutes, and active member participation in democratic processes. The remaining 60% rests on the STEP's financial performance standards, which rely entirely on precise structural mathematics. The S stands for stability, measuring solvency by dividing net worth by total assets. Importantly, the PFRFC requires statutory reserves to be explicitly included in this net worth calculation. T is the turnover ratio, dividing the volume of business by total assets to track utilization. E measures efficiency, calculating cost containment by dividing operating expenses by gross income. P tracks profitability by comparing net surplus prior to adjustments against total assets. And the final S evaluates the structure of assets, measuring the proportion of risk-bearing assets against the total asset base. For lending and credit cooperatives, these metrics are subject to specialized regulatory alignment under Memorandum Circular 2024-07. Their earning assets must be evaluated against codified credit operations manuals, utilizing the 5 C's of credit and verified reports from the Credit Information Corporation. The performance pillar forces cooperatives to mathematically prove their operational efficiency and governance simultaneously, leaving no room for subjective health assessments. The third pillar is the social audit. Currently operating under Phase 1 guidelines from Memorandum Circular 2018-01, it assesses a cooperative's social development performance against its budgets ahead of an upcoming Phase 2 focused on long-term qualitative impact. This flowchart tracks the strict segregation of socio-civic funds. General member education is funded internally through the Cooperative Education and Training Fund. Conversely, external community initiatives must be drawn exclusively from the Accumulated Community Development Fund. To enforce administrative accountability, both the general manager and the chairperson must formally sign the social audit report before it is submitted to the CDA. For some institutions, the auditing framework expands even further. Cooperative banks occupy a dual regulatory space. While registered with the CDA, they are governed by the Bangko Sentral ng Filipinas Manual of Regulations for Banks. This requires specialized internal audit functions and mandates external auditors with senior banking experience. Finally, there is fiscal compliance. To maintain their statutory tax exemptions with the Bureau of Internal Revenue, cooperatives must adhere to strict reporting rules under Joint Administrative Order 001-2025. This mandates the submission of the Annual Tax Incentives Report and the Annual Benefits Report using standardized templates, with a strict deadline of May 15th. The social and specialized audits ensure that a cooperative's statutory tax exemptions are explicitly paid for, with measurable, verifiable community benefits. The tripartite architecture succeeds in forcing cooperatives to balance financial viability with socio-civic accountability. However, empirical data reveals a compliance paradox. The framework's sophistication often creates systemic bottlenecks, particularly for resource-constrained micro-cooperatives. The first major barrier is the diverse background of elected boards of directors. Many lack formal business training, making it difficult to navigate complex STEPS metrics and PFRFC accounting standards. The second barrier is technological. The transition to e-governance portals like KS and eCopris frequently results in server glitches and slow access speeds during critical data migration phases. The state occasionally has to step in to alleviate these systemic crises. During recent national emergencies, the CDA issued Memorandum Circular 2026-07, extending reporting deadlines so cooperatives wouldn't face unfair penalization due to external disruptions. Moving forward, targeted institutional adjustments are required. The CDA must mandate simplified, targeted financial literacy programs specifically designed for non-accountant board members. The regulator must also invest heavily in server capacity and provide localized, pre-programmed accounting software to micro-cooperatives to eliminate manual data entry errors. And as the state transitions toward the Phase 2 social impact assessment, it must prioritize qualitative indicators that allow smaller primary cooperatives to measure their impact without the need for expensive external audits. The modern auditing landscape has matured into a professionalized technical compliance ecosystem. Managing this complexity requires a deep understanding of the regulatory framework to maintain the statutory balance of social equity and countryside development.